Hi, my name is Mike, and today I'm making a quick video about group RESPs, or Registered Education Saving Plans here in Canada, and specifically Canadian Scholarship Trust, which is a supplier of group RESPs. I'll give a bit of a background of what it is and my thoughts about it. I studied finance in university. I worked for a big Canadian bank for a couple years. I consider myself savvy with financial issues, but when my wife came down last week and said that we had an appointment with an advisor from this Canadian Scholarship Trust group, then I had never heard of them. So I looked them up quickly and couldn't find too much information. And so we had the meeting, and I just want to give you my thoughts on this program and this company. So if you don't have time to watch the whole video, my 20-second recap is, again, this is not financial advice, just my own research, my own opinions, is that there are much better products up there that will cost a lot less in fees and that will give you greater flexibility about on what you actually want to do as you save for your child's future education. So probably best just to go to one of the big Canadian banks and open an RESP there for your child. One of the ways these companies get your email or your phone number is when you sign up for these free baby gifts, and I guess they buy the lists from these other companies. And so we got a phone call asking if we would meet and have one of these Canadian Scholarship Trust Plan representatives talk to us about the RESP and the government grants. So I was curious. Accepted and had about an hour long Zoom meeting. I guess usually they do it in person, but because of COVID, they didn't. So the first thing that I want to talk about are the fees. And if you go on their website and you pull up their plan summary, they say that the plan, it costs $200. There's many fees, but one of them is $200 per unit, and this can be between 3.1 and 24% of your investment. So if we look at our specific case, this was for our dollar Kalena, and we were going to do $210 per month, which maximizes the 20% government contribution. Over the lifetime, the 17 years, we would invest just over $43,000, and we would pay the fees, $4,421 in the first 3 years. So basically, you take the 4,421, 4,421, divide by 3. So you're paying, divide by 12. So you're paying, for the first 3 years, you're paying out of the $210 that we're investing, $122 goes directly to this company and not to Kalena's retirement plan, education plan. So if you divide the 4,021 divided by the 42,840, this gives 10%. So basically, right off the bat, they're taking 10% of whatever you're investing. And in the finance industry, that is insanely high. I can't stress that enough. An average mutual fund, even if mutual funds aren't as popular as they used to be, maybe 2%. And if you take an ETF, an electronically traded fund, it could be like 0.05% or something, 0.10%, like very small. This is crazy expensive. On top of that, they charge $10 per year, so that comes up to about $182 when you count the taxes. So right off the bat, you're being charged 10% of your fee and in fees. But that's not the only thing. The other thing is that they also charge. Well, they don't charge it to you directly, but there's a management fee of 0.59% of assets. So basically, whenever they take the money and they invest it every year, 0.59% plus tax is taken off for them to pay their trustees, custodian fees, all that jazz. So that 0.59% is money that you don't get back. It's the return on the investment. that's it's taken away basically. So these fees are insanely high. So basically, like close to 11% is going to be the lowest amount in fees that you pay, and to me that's just insane. Um, Now they do have a little gimmick there that if you make every single payment on time and everything goes good, blah blah blah, you do get a sales charge refund that can be up to half. But again, I didn't ask a ton of questions about this, but from what I can read, you have to not miss a payment. Everything has to, all the stars have to line up, for you to get half of your fees back. Even if you get half your fees back, you're still talking 5%. And you don't get those fees back until your child starts university at 18 years down the road. So they hold on to that money for all that time. To talk about is the risk reward or the return and the type of investments that are in this portfolio. So I pulled out their financial uh, disclosures, and right here, first of all, you can see that they manage $4.5 billion of people's money. So it's not small. So there's a lot of Canadians. If you say the average is, I don't know, maybe $20,000-$30,000 per family, that's a lot of different families that are doing this, being charged a lot of money, in my opinion, for this. So the asset mix as of October 31st, 2020. So if we can, it's kind of small here. I'll make it bigger. So federal, provincial, municipal bonds, 42%, cash holdings, 3%, corporate bonds, 25%, and ETFs, equities, 30%. So basically 70%, 65% bonds, 30% equity. So it's a pretty conservative fund, which is one of their marketing talking points. They say that, hey, this fund's never lost any money in the 60 years that we've managed it. And yeah, it's probably true, because when you're invested 70% in bonds and you're holding for 15, 20 years, 17 years, yeah, you're not chance of losing money are very slim. That being said, the return that you can expect from a bond fund is going to be less than a return from a ETF or an equity fund, because there's more risk in investing in stocks than in bonds. But usually over long periods of time, uh, it's you get better returns from stock funds. In my opinion, if you're investing for your child's education, the time frame, like Kalina was born in January, so this is like an 18-year time frame. It's pretty far. Now, if your kid's 16 and going to school in 3 years from now, yeah, you don't want to risk your principal your principal amount. Um, so that's fair. But in 18 years, I think we're able to handle a bit more risk. So I would like to see a portfolio that's a bit uh, more heavily into stocks and equities, rather than bond funds. I would like to talk about it is if you transfer this RESP to another bank or another company, and this is from their prospectus. They say, um, if you have been in this Advantage plan for more than 60 days, you may terminate your plan and direct us to transfer the RSP to another RSP provider. No problem. But this is what happens. You will lose your sales charge, so that 4,400 that I paid in the 3 years, I lose that. I lose all income earned on the contribution. So any income that came from that investment, I lose all that. So if I've had them for 10 years and then decide to change, I just get the money that I put back in. I don't get any of the interest that it would have earned. Unlike if you're with any mutual fund or any ETF, if you transfer it, you keep the earnings. So in conclusion, I just want to tell you what other options are out there and what we did. So if you want to play it safe and have a bond fund, you can walk into any Canadian bank. I'm using RBC here, for example. You can walk into the bank, ask them to open an RESP for a child. You can ask them, hey, I want a bond fund. This bond fund averages about 4.7% per year since it started. So it's relatively same investment as what a Canadian Scholarship Trust. They were using 4% as their benchmark to predict future values of money. But the difference is that the MER, the fees are 0.16% instead of 10%. So huge difference. If you're willing to risk a little bit more, you can go into an equity fund. An equity fund, they average probably closer to 8%, and again, the fees 0.76. You can get, there's hundreds and hundreds of different funds, but you can get some that are a lot cheaper in fees than even 0.76. And I just want to show you the difference if you invest in one fund over the other over 18 years. So again, just investment growth calculator, no initial investment, 17 years at 4%. That's what they're using. If you invest 210 monthly, at the end you get about 50,000 out of the $36,000 that you had invested. That doesn't account for the 20% that the government gives, but that's okay. I just want to show you basic numbers. And then if you use 8% instead of 4%, it jumps to 72 instead of 50,000. Okay, so that's $22,000 difference over the lifetime, and these are funds that on average throughout history have yielded that. So it might change a little bit, but it just gives you an idea that you will make much more if you invest in an equity, if you can handle the up and down of the market. To save even more fees, we opened a Quest Trade, our RESP account, no fees, and we bought an index fund ETF, which basically means it just follows what the Canadian stock market does. Management fees are 0.05%. That's it, that's all. If I decide to change institutions, or if something changes in the future, I can always stop my contributions. I don't lose whatever I've gained, and it's way more flexible, way cheaper. It does require a little bit more management. That's why if you don't want to manage anything, just walk into RBC or TD or CIBC and talk to someone, and they'll get you set up. So thanks for listening to my video today. If you got any questions, you can ask in the comments. If you like it, thumbs up. All right, have a great day, guys.